Friday ended the week in a fairly red position, not something we've seen in several months in the S&P, and reasons that we'll touch upon. But if we do just take one step back and look at the month of July, for the large part we are seeing a lot of stocks performing very strongly, but actually we're starting to see some stocks creep into the red. And we have to warn you that August and September have historically been the poorest months in the whole year. Whether or not we'll see seasonality, something to bear in mind. And we're also seeing investor sentiment step back from extreme greed. We saw that not that long ago, and now they're sitting firmly in neutral, something I'm personally not surprised about. As I've said, companies' valuations continue to be stretched, and it's very difficult, no matter what valuation metrics we use, to really say there is a lot of undervaluation. Now, some of the reasons why we have seen the market turn a little bit sour, we heard from the Fed, who in fact held rates, even though this is something Donald Trump has aggressively been asking them to cut, and for quite some time. We're seeing the word uncertainty come in, and for some very good reason. Tariffs are in place, and we've seen a lot of those that were paused unless a deal was made now come into fruition. And all of this has really got investors wondering the true cost of these tariffs, what it's going to mean for their favorite companies, what it's going to mean for their earnings, not particularly this quarter, but actually moving forwards. And it also didn't help to see some of the numbers, in fact, for jobs revised for the month of May and June. This is ultimately highlighting a bit of a slowdown. Whether in fact this is the beginning or a one-off, definitely something investors are thinking of. And perhaps with companies reporting their earnings, not only Procter & Gamble, but we're seeing many of them report and discuss how consumers are more anxious, they're under stress, they're either buying less of some of their favorite well-known branded products, or in fact are moving completely away to cheap alternatives, and that could be a good indication as to where the current market is and perhaps heading in the shorter term. Which leads us onto today's episode, where we're looking at 5 quality stocks that we believe are great contenders for buys in the month of August. We're talking undervaluation, which we're going to get onto, and we're going to discuss very briefly each one, including our own valuation perspective. Starting off with Bristol Myers, down over 8% in the last year. Year to date, down 22%. In just 2025 alone, 1/5 of their market cap wiped out. And over the last 10 years, it hasn't been the best performing, down 30%. But this depends ultimately at which point you buy. Currently trading near their 52-week low, and whilst we only get one buy from Seeking Alpha, we're not going to get into it today, but extremely rare to see on the channel. A+ valuation, A+ on growth, and then A+ on profitability. We also like to compare some metrics against their 5-year. Firstly, their forward P sitting at 7, below the 5-year average of 8.3. This, in one sense, is an undervaluation signal. As always though, we don't look at any one model in pure isolation. Yield also highlighting undervaluation. 5.61, very strong starting on offer for investors, above the historical 3.4. And also worth pointing out, given they do have a very high yield and above their 5-year average, that it does look to be safe with a score of 70. And the other metric that we like to look at on valuation is the blue tunnel, which within the parameters signals fair price. As of today, we see it just outside the bottom end, something we've seen in parts in the last 12 months. And they did report their earnings just days ago, where worth highlighting they cut their full year adjusted view, but actually they raised their expectations for top line revenue, and in particular they said their growth portfolio top line was increasing at 18%. And something that's always good to do when you're looking at companies, particularly in these industries, is to see what is in their pipeline. Now, if you want a specific look, all of this information is directly on their website. It goes through the different phases, which ultimately the further along it is, the further it is into production. And we can see there are a lot of products, and all of these are in fact covering different areas. So great to see, as expected, Bristol Myers having quite a pipeline, and we also heard from them not too long ago, you could probably argue, particularly to circumvent some of the large tariffs Trump has been talking about for pharma companies, that they're looking to spend around $40 billion in US investment over the coming years. And another element of review is seeing what institutions themselves are doing with their 77% ownership. They sold $8 billion in the last year, pretty much buying twice as much, so clearly a lot more bullish. In the most recent quarter, we do see pretty much the same, neither net buyers nor net sellers. If you wanted to see the reverse of the trend where they did turn in fact bearish, you'd have to go back to Q3 2023, highlighting overall institutions a lot more bullish than bearish. Now our intrinsic value for BMY today gets to $60. As you can see, it's purely the average of the three models, which when we come to do our deeper dives on companies, we explain each one, talking about the inputs and outputs. While we won't get into the detail today, the only thing we will highlight for those interested in the DCF model is that by using a reverse DCF calculated into the current market value is a decrease of 7.5% year on year. Now, if you look at that and believe that is incredibly too low, in fact it should be positive, then straight away potentially undervaluation in your opinion. Just to highlight as well, we factored in negative 4% year on year, so you could argue maybe this is very conservative. Now we're not done there, because we always apply a margin of safety, kicking off with 10%, execute if it meets the three golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to $54, then we keep going till it's near the current trading price. In essence, we're saying for Bristol Myers Squibb, we see a 25% MOS up to $45. Wall Street themselves see this at $57 into 2026. That is translated to 30% upside. We can also show you here at 30%, a buy at 42, and at 35, 39. But at a 25% MOS, 30% upside, also a very attractive starting yield. Let us know your thoughts on BMY if you see it as a buy, hold, or avoid. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to a spreadsheet dropping this morning. We're looking at severely undervalued stocks for the month of August. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Salesforce, which is down 1% over the last year. Year to date, down 25%, 1/4 of their market cap wiped out. And over the last 10 years, even after the drop, we still notice outperforming the S&P, up 256%, trading very similar to stock number one near their 52-week low, quite a way away from 52-week high, $370, with not just a double buy from Seeking Alpha and Wall Street, but the Wall Street 4.35, not too far off the 4.5 to flip this into a strong buy. Now forward P 21.5, well below the 5-year average of 31, so severe undervaluation, whilst also getting a marginally higher yield, 0.66 versus 0.58. And we can also see here the disparity between where the company sits today and the lower end. Whilst the blue tunnel has been decreasing, not something we like to see, disparity is still showing, therefore potential undervaluation. And if we were to zoom out to the last 5 years, this is one in fact from 2022 all the way, we would say, to this point in time, has continued to trade severely undervalued. So maybe one, the market continues to misprice, it continues to offer at a very attractive valuation. Now in their last earnings, they actually raised their full year outlook whilst performing a double beat. And we can see here EPS beat as well as that of the revenue. Now this one, unlike some of the others today, is yet to report, as we note here, 27th of August. So we will be expecting a very consistent beat, as they typically do perform. And out of the next 4 quarters, not only is each one showing growth, but 3 of them double digit with a 75% track record, 3 out of 4 beats. And if you believe they can continually hit their EPS target, we notice on their next full accounting period, they're trading at a forward P of below 20. We'll also highlight that similar to ServiceNow, they're in talks to invest in Genesis, and this is something to further support their company making AI-powered software for customer contact centers. And that is probably going to be very critical to the business. As we can see, not that long ago, the CEO said 30% of their internal work is in fact being used by artificial intelligence, and he goes on to say up to even 50% is being used. And remember what this ultimately means: the more work that gets to be done by AI, cost will be reduced, and therefore investors will see that through a larger bottom line net income as well as larger margins. Now, just days ago as well, he went to reassure those who were employed that ultimately the AI agents won't lead to mass unemployment. And he says that AI agents are now successfully able to resolve 85% of Salesforce's customer service inquiries, as well as qualify their own sales lead 40% faster than before AI. So very positive, definitely a company that is using artificial intelligence to their benefit, and hopefully we will see that in the results this quarter. Now, institutional ownership sits at just above 80%, 24 billion selling, a lot more buying at 36 billion. Pretty similar again to stock number one, where we do get pretty much the same amount of buys and sells in Q2. If you want to see the reversal, but by quite some distance, you can see Q3 2023. Now, our intrinsic value, $371, derived from one model, so we will just explain. We have the free cash flow growth year on year. Just look at the last few years, we're talking very high numbers. Now, we've gone a lot more conservative at 8% when the average sits at 28%, and we get the growth rate, the discount rate, to ultimately give us the present value of future free cash flow. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to 371, indicating 48% upside. Now, we'll also flag here we have a low, medium, high, 8, 10, 12, and as always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CRM or any others. But full transparency, at 10%, 427 if you believe it should be higher, 71% upside, and at 12%, we're talking 491, 96, that is a near double. Now, using the low rate to be extremely conservative, we also want to flag baked into the numbers is 2.4%. If you believe that is way too low, definitely one we would say that looks to be seriously under consideration. And you are getting quite a chunky margin of safety at the lower 8% rate. 20% a buy at 297, at 30% 259, not quite 35, we're talking somewhere 30 to 35. Wall Street themselves extremely bullish, 355 into 2026, 42% upside. Let us know, is this one that you would like to consider in your portfolio? And just to go one step further, for those that want to be extremely conservative, at 6% growth rate, you are still getting a very respectable MOS. We're talking up to 20%, up to 258. Salesforce, let us know your thoughts below. We then move on to ASML, which continues to get hit, down 22% over the last year. Year to date, they've now turned negative, although barely, and over the last 10 years, still with the drop, outperforming the S&P, up 611%. They're also trading near their 52-week low with a double buy from Seeking Alpha and Wall Street, and another severe undervaluation, forward P 26 below the 5-year of 33, yield above 1% with the 5-year at 0.8, and no surprises, we get that severe undervaluation, but similar to others today, been in that space for quite some time now, but over the last 5 years that actually doesn't hold true. More often than not, we see severe overvaluation, or in fact in the blue tunnel. Now, the main reason we got one of the drops, because this continues to fall, is that they did say there is uncertainty and they do put the blame onto tariffs, where they effectively said they could no longer guarantee growth in 2026. Now, some people will consider this sandbagging, essentially saying management are saying this to lower the share price. Why would that be something they want to do? Well, they still have just over 50% of their share buyback program left, and they continue to add many shares every single week, and therefore if they're adding, maybe this is one for consideration. But as always, nice to see share buybacks essentially returning excess cash to investor pockets. And we also heard months ago during the Liberation Day period that tariffs won't stop companies buying ASML machines. Maybe it'll stop the sale of other items, but that ultimately this is the only company in the world that is capable of making these very specific and expensive machines, where in fact we can see here they're top of the line. Each one goes for around $400 million, and that there are no alternatives anywhere in the world. That is what we would call a very strong moat. Having said that, a lot of investors believe that their moat will be penetrated. We can see here, in fact, companies emerging as an EUV challenger, and there's always this overhang of China potentially building their own machines. Not something we've seen at the moment. Investors will either sit on one side or the other of the fence. One, that no matter what China will do, they will never be able to keep up with ASML. And on the other side of the fence, investors believe it is only a matter of time, and therefore, whilst the company looks undervalued, in its true nature, it ultimately is not. Now, institutions hold 26% ownership, selling and buying the same in the last year, but actually we get nearly twice as much buying in Q2. However, worth highlighting, in Q4, we do see the reversal of the trend in 2024. Fairly recent. In our intrinsic value of $910, again derived from the DCF model, is using a 12% growth rate. Worth flagging, baked into the numbers today, is just over 8%. Now, if you believe 12% is in fact appropriate, you are getting a fairly substantial margin of safety today. As we keep going, 30%, not quite there yet. We're sitting around the 25% mark at $682. Wall Street also like this $900 price target, 31% upside into the next year. Do let us know your view, but ultimately we'll highlight the lower level of 10% today, whilst you are getting a margin of safety. Obviously not as much given the lower growth rate. It's not at the 50% level just yet, sitting somewhere 10 to 15. But let us know, ASML, is this one you're considering buying or in fact already hold? We then move into the railroad, which is Canadian National Railway Company, down 18% over the last year. Year to date, down 9%, over the last 10%, up although marginally 49%. Trading pretty much around the 52-week low, with a double buy from Seeking Alpha and Wall Street, although we would say fairly weak at 3.6, 3.67. But not only do we get a severe undervaluation signal, forward P 16 versus 21, this is the lowest on offer to shareholders in the last 5 years. Likewise, yield of 2.8, well above historical 2, and the highest in the last 5 years. And given what we just mentioned, worth highlighting, dividend safety for now does look to be very safe at a score of 97, and that the blue tunnel methodology, whilst also highlighting for the majority of the last year trading in severely undervalued levels, it still holds true now, disparity getting larger at least in the last few weeks. But actually, when we look at the last 5 years, not once until 2025 was this company ever trading in a severely undervalued level. Maybe something useful, maybe not, but just worth flagging. Typically, this company does trade in a reasonable value. Now again, tariff uncertainty is something that we're hearing time and time again. In fact, you will know this if you do watch a lot of our earnings deep dives, but this is something that has hit Canadian National Railway too, and they've ultimately had to lower their 2025 outlook, and they believe we will see a lower figure, especially in their freight volume. And we thought we'd also highlight that whilst we have focused on CNI today, Union Pacific is another one that could be up there for consideration. They are in fact looking to close a deal to buy another railroad company, Norfolk Southern. But going back to CNI, institutions 81% ownership, selling $4.3 billion, buying a little bit more. However, in Q2 they've ramped up the buys, $405 million versus $36 million selling, something we saw in the previous quarter. You'd have to go though Q2 2024 to see the reversal. In our intrinsic value, the average of the four at $108, although you can see each one, perhaps you want to remove any, you can just simply do that, will give a margin of safety given the current price in the $93 region, not at 20% just yet, would be a buy at 87, at 25 would be a buy at 81, but as of today, we're talking around the 15% margin of safety level. Wall Street, they like this one, $117 price target, 26% upside. Yield also very attractive. Let us know, CNI, maybe prefer UNP, or Railroad just doesn't have the growth you're looking for. We then move on to Novo Nordisk, the company that cannot catch a break, similar to UNH and a few others, down 64% in the last year. Year to date, down 44%, trading like a company that is going to go to zero in the next few weeks. And over the last 10 years, they've now underperformed the S&P if you've been holding from 10 years ago. And whilst they're trading pretty much at a 52-week low, it feels like so long away that they were trading at a 52-week high of $140, and we only, as of today, get one buy rating from Seeking Alpha. Now their forward PE sits at 12, well below the 5-year average of 30. That is a severe undervaluation signal. Yield of 3.4%, well above the 5-year at 1.41. And whilst we do get a very safe 90 dividend score, we just want to flag that this was reduced 2 days ago from 99. So whilst it does look very safe, it has had a reduction, and you're probably not surprised to see this, and this is actually quite a telling signal. We're noticing the intrinsic value for the large part is either flat or increasing, but we're seeing from the beginning of the year disparity expand further and further. That is another massive undervaluation signal. And you can see here, if we go back to the last 10 years, whilst it now sits at around 12, that is the lowest in the last decade. Doesn't mean it's a buy signal, but just absolutely fascinating to note. And for those that don't know, the main bulk of the recent cut, in fact, was their guidance, which they did in fact lower. And you can see, whilst it was double digit expected around May, they've now lowered this to the high single digit to 14%. Not only has that been hit, but they've now lowered quite substantially, we would say, their operating growth as well as their free cash flow, which is why you may be surprised if you didn't watch our latest NVO deep dive that the price targets have been absolutely slashed. And if we look at the institutional ownership at 12%, selling around 6 billion, buying a little more at 7, they bought actually a lot more in Q2, nearly 1 billion versus 300 million selling, but we saw the reversal in Q1 2025. Now our intrinsic value at $53, as you'll be able to note, the main reason why these numbers are substantially lower, we've used the middle rate of what they now expect for 2025. Now even using the middle rate of 14%, you can see upside of 10, baked in though as of today is 12.6%. Now you can look at this in two different ways, like we did in the deep dive. We've used their free cash flow growth expected for 2025, use that moving forwards. Or if you want to see another response where we've actually reverted back to initial guidance, for those that believe this is just a one-off, then these values will be slightly different. So look, using the middle rate at 14%, you are going to get a margin of safety. At 10% is pretty much where we see it today. Now Wall Street, they're very bullish. Clearly they see this as a one-off, and they have a price target of $73, 52% upside. But even with a 10% margin of safety, this definitely looks like one that could be under good consideration, but does ultimately depend on your view, not just the company, whether or not they can rebound from what is in fact one of their largest income streams. If you want to see 15% MOS, a buy at 45, at 20, 42, and at 25, $40. So at 10%, let us know, NVO, a buy, hold, or avoid. And we can also flag for those that believe it should be higher at 16%. Naturally, you are getting a large MOS. And as we keep on going, that is sitting at 20%. But as we said, give us your views. We then move to T-Mobile US, which is up 27% in the last year. Year to date, they're up just under 8%. And over the last 10 years, nice outperformance of the S&P, up 495%. The only one today that actually isn't trading near 52-week lows, bang in the middle, with one strong buy from Quant, first time we've seen that today, a buy from Wall Street with a hold from Seeking Alpha, and this one, like others, is trading below their 5-year average at a forward P of 20 versus 24, yield not too dissimilar from the 5-year, and we also, like others today, get to see the undervaluation. There is disparity between the 2 points. If we were to zoom out to the last 5 years, actually for quite some time this was trading in severe undervaluation. Nice to note the intrinsic value has been increasing in the longer term, and they reported a couple of weeks ago, market loved it, they added more subscribers than their rivals. Not only that, they also raised their full year guidance, and this is something we have seen before from T-Mobile. Their previous earnings also showed the exact same thing. There was strong subscribers subscriber growth. And actually, if we look at the company's metrics, revenue grew 6% last year, expected about that this year. That is on both accounts above the low single digit of the sector, but actually they're growing their revenue slower than the last 5 years. Earnings per share, though, impressive at 16%, above the sector at 12%, but slower than the historical 32%. And profitability, impressive at an A+, gross margin 64%, above the sector at 53%, also above their historical at 61%. Bottom line, showing exactly the same, efficiencies 15%, well above the sector at 4%, and their own 5-year at 7%, and equally as impressive, cash generated from operations, 26 billion, well above. We get to see their 5-year at 16, and in fact the sector in the millions. Now institutions with their 43% ownership sold 10 billion, buying a little bit more at 13, bought a lot more actually in Q2, 753 versus 156. If you wanted the reversal of the trend, well, you'd have to go Q3 2023. Now, our intrinsic value at $287 is derived using a 10% growth rate, and now you can see baked in is 8.1%. If you believe it should be higher at 12, well, 345.46. So not looking as attractive perhaps as maybe the others today, but could be one for the watch list at a 10% MOS, a buy at 258, at 20, 229, so you're currently getting around 15% up to 244. Now Wall Street see this at 268 into the next year, 13% upside. Do give us your thoughts on this company as well as the others. In your view, are they a good buy in August, a hold, or in fact an avoid? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.